Welcome to Farm Here Daily, a field forward podcast. I'm David Geiger, your host. Today on Farm Here Daily, we're going to go over tariffs and new trade deals and recent changes at the U.S. Department of Agriculture with economist Chad Hart of Iowa State University. Please be sure to like and follow the podcast as well as our social media channels. We would love to have you join our community, keeping folks informed about what is affecting our farmers. This is Farm Here Daily. And joining me on Farm Here Daily, we have Chad Hart. He is an Iowa State University economist. I wanted to talk to you because there's all sorts of things going on that's affecting the economy for the farm and farm businesses in Iowa. Let's start off with one of the more recent announcements, which involves trade deals. We had over the weekend some talks with the EU. Can you break down a little bit of what you know and how that might affect Iowa?
Sure. As we're looking at the EU, trade framework, it looks like the U.S. will be charging a 15% tariff on most of the goods that come from the European Union. The European Union has agreed to not put any additional tariffs on U.S. products going in. That's really good news for Iowa. As we look at our agricultural exports, the EU is a major trading partner for us, especially right now. They are currently the second largest market that are buying U.S. soybeans over the course of the past year. They're the fifth largest corn market right now. And so having some more certainty around potential tariff levels definitely helps us as we're looking there. The other thing that has been mentioned, although we don't have a lot of details on this yet, is it sounds like some agricultural products have been completely exempted from any sort of tariffs on either side. And so, again, good news as far as keeping, let's call it, barriers to an already good sized market for U.S. agriculture open.
How valuable is the European market for the U.S. and Iowa in particular?
It is a good sized market for us, but it's not one of the top three. I mean, when we're looking at from an Iowa perspective, it is Canada, Mexico, and China. Those three sort of dominate the scene for us. But when you think about that next set of countries behind that, you'd get a South Korea, Japan. The European Union factors in at about that level.
The other trade deal that was announced more last week was Japan. Do we have any notes on that? When I was looking it up, it seemed pretty, hey, we have a deal situation. It wasn't an actual detailed list.
No, I would say it's very much like the deal we see with the European Union. The idea is that in general, we're looking at a 15% tariff. Again, no retaliatory tariffs coming from the Japanese side, with some exemptions carved out for certain products. The difference mainly between the two is that, at least for the European Union, agriculture was sort of listed there. Whereas with the Japanese deal, the only agricultural product that I saw mentioned was rice. And that's, in this case, opening that market up a little more to U.S. rice. We do export some rice into Japan. This should help, broaden that out just a bit more.
And specifically when it comes to Japan, like you said, it's not in the top three, China, Canada, and Mexico, but I believe it is in the top five. So this is a pretty big corn and soybean destination.
Yep. Traditionally, they have always been a very strong market for us. In fact, you could go back, say, 20 years ago, Japan would have been in that top three. Over time, they're still a strong market for us, but yeah, they've been replaced over the years. Especially with the growth that we've seen with Canada and Mexico under what was first NAFTA and now the USMCA agreement.
Let's move over to tariffs in general. How have you seen them affect the Iowa corn and soybean meat markets in general over the last 6 months, 7 months of the new administration?
Well, that's the deal. I think the tariff uncertainty sort of prevented the seasonal price rally we tend to rely upon for our crops. If you think about traditional crop pricing, the idea is that we tend to see our strongest prices April, May, June of the year, as basically you're seeing building demand for the product, and at the same time too, uncertainty about supplies as we look forward. Well, this year we didn't get that seasonal rally. In fact, the tariff announcements just sort of seemed to stop any sort of momentum that the crop markets could find over the course of this spring into summertime. And so we've been treading water on the crop side. Now, when you look at the livestock pricing, that has been better. We've seen some strength there, but that strength is much more driven by domestic demand for our products, helping hold, in this case, those prices higher. Of course, cattle is also being helped by just the, limited supplies of cattle that we have, leading to less beef production as we're looking out there. Pork is more susceptible to concerns about trade there. And that's where the deal with Japan, again, looms fairly large there. One of the things I'll be watching for is, again, there's probably South Korea and then China would be the markets that we need to see some sort of framework put in place to help solidify potential trade partners.
Chad, let's go more to a domestic outlook of what we're seeing here in the United States. I want to, before I get to a couple topics that are very recent in the news, I want to cover the One Big Beautiful Bill Act and its involvement with essentially what typically are farm bill items. Is the changes made there, or are the changes made there enough to defer or push away a farm bill for now?
Arguably, they could. I mean, if you think about it, what the big, beautiful bill sort of did was it basically covered the big fight that we tend to have within a farm bill, trying to figure out, how much growth is going to happen in the nutrition title versus the commodity title, the title that creates the ARC, the PLC payments that we see. And, within the bill, what they did was they basically said, nope, we're setting those rules up. And in fact, in the case of those ARC and PLC programs, they extended those regulations until 2031. So it essentially says we wouldn't need to touch the farm bill again from those two titles perspective. The challenge is going to be, though, those aren't the only two titles in a traditional farm bill. When we look here, I think there's still a need for a farm bill, but it's going to be much more concentrated on those remaining titles. The biggest ones that we tend to stare at would be conservation title, so CRP, CSP, but also thinking crop insurance tends to be adjusted in the farm bill. You have your trade title, your research title, and on down the line. Rural development would be another. And so I think there is a need for a farm bill, but this takes a lot of the political pressure off, at least here in the short run.
So when we talk to farmers and farm groups, and a common concern we get is, this was made in 2018, times are much different than they were then. The numbers side involved in events like ARC and PLC were changed to be updated. But is there anything else or anything new that needs to be placed into a bill that farmers are really dealing with right now in a very negative way?
Well, I think the challenge always is when you look at how our farm bills have tended to evolve, and especially those commodity title programs. Congress and USDA are constantly playing catch up, basically, trying to figure out, okay, what didn't we expect over the past 5 years that happened that forced us to create some ad hoc disasters and something like that? And can we build that into the new Farm Bill program? And that's how we tend to evolve these things. And as you mentioned, the big, beautiful bill does some updating, but it really doesn't change the structure of the programs. I think for a lot of producers, they're looking for beyond just a simple update of the pricing within those programs and looking to say, hey, can we adjust these programs to maybe be automatically scaled to match not necessarily the prices we're facing, but more the costs that we're incurring as we look at what support levels need to be. I think for a lot of folks over the past several years, they would say that, when you look at ARC and PLC, yeah, we had those reference prices, but they were well below production cost estimates. And therefore, even if once the programs would kick in, it's, if you will, too little, too late. The idea is, can we get some sort of support mechanism in place that is a meaningful safety net for producers as they look forward?
On that point, and we talked about tariffs more when it came directly to commodities, I think of something that we've been dealing with for a while in farm, which is very high input prices for products like fertilizer, which mostly are imported from other countries and therefore affected very much by tariffs. When you look at not just supply chain issues and disruptions that we've seen over the last 6 years, but also tariff problems going on with fertilizer and production and supply issues with wars across the world, what would be a way a farm bill might be able to handle that?
Well, that would be the deal. That would say instead of focusing on market prices to set the support levels, can we create something related to production costs? Because those production costs would take into account automatically supply chain disruptions. It would take into account automatically tariffs on imported inputs that we tend to utilize. And so that could build in automatically to that style of program. Whereas if you look today, the idea is since we're looking at market prices to set those bounds, no, it doesn't take into account what's happening on the input side. And it's definitely not reactive to those tariffs placed on the goods coming into the US. You can argue that the market prices do respond to the tariffs other countries are putting on us and the feedback it has on our market prices. But that feedback tends to come again too little too late. If we think back to President Trump's first term, that's why we saw the need for market facilitation payments, that the current farm bill structure could not respond fast enough to the damage that was being done in that trade fight.
Hey, Chad, hold that thought for just a moment. We're going to continue talking about the farm economy here, but we are going to take a look at the closing markets. And there was some negative trade going on in the grain sector at the close for Monday. September corn 5 3/4 cents down 3.93 3/4. December falling a nickel at 4.14. Soybeans in August down a dime, $9.88 3/4 cents. September beans 9.5 cents lower, 9.92 1/2. Soybean meal in August $2.90, a ton in the red at $264.90. September wheat up a 1/4 cent at 5.38 1/2, with December rising half a penny, 5.58 3/4. In livestock market close for Monday, August live cattle up $1.40 a hundredweight at $227.87. October $1.62 more at $224.77. Feeder cattle in August $2.15 a hundredweight higher at $333.52, with September rising $2.35 at $334.55. Lean hogs in August down 17 cents a hundredweight at $108.52, with October 27 cents more at $90.87 a hundredweight. That is the Monday market close. This is Farm Here Daily. More locally, we're dealing with some new processes at the USDA with the new administration. And one I think of immediately was announced just last week, and that is a massive reorganization. We heard about this when Sonny Perdue was Secretary of Agriculture too. He wanted to move a lot of jobs to more rural areas, more farm-centric areas. And it looks like we are now getting that again here from the Trump administration, where they're moving to 5 different locations with, I think 50 to 70% was the number that I heard of USDA employees being relocated. What does that mean for the farm economy?
It's going to create some disruption. I mean, if we look back to President Trump's first term, and he made this move with a couple of smaller parts of USDA. In this case, back then it was the Economic Research Service and NIFA, which is their granting agency. And we did see significant turnover within USDA, which led to a slowdown in those programs and what they do. I expect something similar here as we're looking at this next layer, if you will, to this. But the challenge is going to be just how deeply does it reach into some of the programs that farmers rely upon. Case in point, probably the 2 biggest areas I'm going to be watching would be Farm Service Agency, so FSA, and NRCS, so Natural Resources, because those 2 entities run the vast majority of the programs that are farmer focused, farmer driven. Um, I know the administration is touting this as that, by doing this, that these agencies will be more responsive to farm concerns. At the same time, too, I don't think we gain that moving to these regional offices, because I would argue that responsiveness is already there at the county offices, at the state level offices that we have. And so this doesn't necessarily help that in any way, shape, or form. What I am concerned about, though, is that it could hurt the ability for USDA to rapidly turn around policies such as the Big Beautiful Bill. Because if you think about it, with them being located in Washington, D.C., the representatives from the Farm Service Agency, they can go and talk with congressmen and legislative assistants and other parties within USDA that they need to, if you will, coalesce with to implement those programs much more quickly if they're in the same city, basically in the same building in the most case here, as opposed to having to set up meetings across these regional centers.
I think another criticism I hear often is this is just a way for USDA to reduce, I guess, the cost of the USDA. By doing this, there's a pretty decent chance that many of the established USDA employees will not want to move away from their families or what they've lived with for however long they've been in the DC area and then move to one of these hubs. Is that a aspect for cost reduction that could affect in terms of like knowledge and information that employees that may have been there for 30 or 40 years may have? Or is that simply maybe a more political concern?
Oh no, I would say that's definitely part of the equation here. That the administration is looking for cost savings, and they do know that a fair number of these career employees will not make that move. But there will also be that loss of institutional knowledge because of that. And it could lead to other costs as we look down the line. Not only will they have to hire individuals to fill those roles, but then those individuals will have to learn on the job, and that may cost additional time and effort as we're moving forward here. So in the long run, it'll be interesting to see whether this actually truly does save cost or not. Um, but it definitely, like I say, sort of upsets the apple cart, at least here for a little bit, especially at a time when USDA has already been adjusting to layoffs already across the board with some early retirements as we look out there, along with trying to figure out how to implement some of these new programs and procedures that are coming down from the administration.
Chad, I want to move to kind of a persisting story that we've seen across the country when it comes to a farm issue that hasn't really been touched too much by bills or by farm bills or locally even, and that is the increasing cost of land. And the reason why I say that is we know from research at Iowa State University that I think it's like 84% of Iowa farmland is owned. It's not, there's no payment on it. And so we know a lot of land is owned in Iowa. However, we have this issue coming along where new, beginning, younger farmers, even farmers who are on a generational farm that want to keep the farm and the family, are struggling to afford being able to either get in or even purchase out the land from their siblings or family members as the land is passed on. What are ways that you're looking at that issue? And is it actually that big of a problem when it comes to the economy of the farm?
I'd say it's more of a challenge than necessarily a problem, because in this case, I would argue this has been an issue for a long time within agriculture. In fact, I always like to point out that when we think about this issue of how do we get the land to the next generation of farmers out there, that's been something that's been on the mind of, I know, like Iowa State economists since you know Bill Murray back in the day, and back when he was running for governor of the state of Iowa and setting up living history farms, he was worried about that same issue, and it was a lot of the same discussion about how, land values were high and that new farmers, beginning farmers, couldn't get into the game. And here we are now, 80 some years later, and we're still asking the same questions. So it's a challenge, but it's a challenge we figure out a way through. Now, one of the things I think that has changed over that 80 years, though, is what does it take for that newer beginning farmer to get a foothold into building a farming career? And back in the 1940s, 50s, 60s, I would argue sweat equity would get you a long way, that you could hopefully build up over time and get in. Whereas we know today, farming is much more capital intensive. And along with that change comes the change that we've seen, the extreme movement that we've seen in farmland values, because the farmland represents the biggest asset that any farmer is going to have in their farm for their career. And farmers will basically, they'll spend on land every opportunity that they can, but they'll never let go of a piece unless they absolutely positively have to, which what that does is that continues to drive prices higher. And so while we're looking at record or near record high farmland values, a lot of that is driven by the agriculture community themselves. That you mentioned, a lot of this land is owned outright. Well, who's it owned by? It's owned by either existing or, recently retired farmers. And that they tend to see that land as their legacy as they're looking forward, which means, one, we don't tend to sell a lot on a yearly basis. And with limited supplies on sale, that tends to drive prices up. At the same time, too, you've got a lot of farmers who are always looking to expand their operations. That means there's a lot of demand for farmland, again, tending to drive prices up. And so it's sort of it's an issue of our own creation, in that we would like to be able to blame other parties, but for the most part, no, it's because of the way agriculture works that we are driving up our own input cost when it comes to farmland values.
Chad Hart is an economist at Iowa State University focusing on farm and the farm economy. Thank you so much, Chad, for joining us on Farm Here Daily.
Thank you.
Thanks, Chad. We appreciate it. Again, this is Farm Here Daily. Thank you so much for joining. We would love to have you join our community as well. So like and follow the podcast and check out our social media channels at Field Forward Pod. You can also find me on social media at Geiger Reports, as well as WHO TV Channel 13 every weekday in their morning and noon hour programs. Again, I am your host, David Geiger, and I'll be back again tomorrow, everybody.